gentlemen, and welcome to the first GuruTalk session of the academic year 2013-14. Every month, AVAGMAH brings this event, offering to you, dear students, some of the most outstanding personalities in today's globalized world. It is in this connection that I request you to put your hands together to extend a warm welcome to another outstanding human being, our Guru of this morning, Mr. Shankar Sharma. It is my proud privilege and honor to share a few details about Mr. Shankar Sharma. Mr. Sharma heads the Global Strategic Group at First Global, which is a cell in charge of identifying key changes and inflection points in markets across the world for its global clients. Prior to this function at Global Strategy, Mr. Shankar Sharma worked in the Merchant Banking Division and then the Corporate Financial Division of Citibank. He then set out to globalize First Global's operations to international markets, following which he gained membership of the prestigious London Stock Exchange and also the membership of the NASD US, enabling First Global to start trading in the US market. From 2002, First Global built its research coverage of global companies and economies around the world. First Global's research independence, unbiased stance, and ability to discern trends ahead of the street have made it a global research company with tremendous following amongst institutional investors worldwide. There is another aspect of Mr. Sharma which I am sure will gladden every heart. Mr. Shankar Sharma also now heads and spearheads Cerebra BrainTech, which is a venture to provide technology-driven solutions to neurological disorders like autism, attention deficit, Alzheimer's, depression, as well as solutions for students and corporate executives to improve their memory, attention, focus, and overall cognitive levels. We are indeed privileged to have you with us this morning, Mr. Shankar Sharma, and on behalf of AVAGMAH, our dear students, and myself, I extend a warm welcome to you. The talk will proceed on the following lines. Mr. Sharma will address us for about 40 to 45 minutes, after which he has very kindly agreed to field a few questions for about 15 minutes. I would request you students to identify yourself, your name, and the course you're doing when you address your questions to Mr. Shankar Sharma. Let me not stand between you and our Guru of this morning, and let me present to you Mr. Shankar Sharma.
Good morning, everybody. Can you hear me? All right. Okay, so here we start. I hope to take about, let's say about 30, 35 minutes or so on this very interesting topic that most people would, especially business school students, students of finance would appreciate. And after that, usually I find that whenever I'm not, not on a webinar, but in a physical conference that I go to address students, I find that the question and answers are usually the most important aspect of any talk. So I will leave aside a reasonable bit of time for the Q&A part. All right, so let's jump right into this presentation, which is on the inner game of investing and trading. Okay, so now here we go with this first slide, and which is that is investing different from trading? Simply put, the principles of the two are largely the same. Investing can generally be for longer term, while trading is more short term. However, and this is very important to understand and appreciate, trading can be for reasonably long periods of time as well. So I know of many traders, including myself, who can hold on to a position for very long periods of time, but while not having categorized the position as an investment. So we are always open to changing our view, but we remain invested in that particular position for 6 months, a year, even a year and a half or 2 years. So really speaking, unless you're a day trader, there is very little difference between investing and trading. So I like to always specify this and make it clear to people that it is really ultimately two sides to the same coin. Now, obviously, I'm sure pretty much all of you are aware that the most critical things in a company or in stock analysis are fundamentals and technicals. Okay, so let's talk about what are the fundamentals that you need to focus on. And there are a million things to look at, but the key is always to focus on return on equity, return on capital employed, and free cash flow generation. These three are the cornerstone of any good securities research or good securities analyst. Return on equity is nothing but return on net worth. When we say equity, it is not just equity share capital. That's a very common mistake that I always hear back from India students. When I ask them what is return on equity, they will say the profit divided by the equity share capital of the company. That's incorrect. When we say equity, we talk net worth. So that is the share capital plus the free reserves of the company. Right. Return on capital employed is adding up all the liabilities as well to the net worth, so that you get the entire amount of monetary capital the company is putting to use in order to generate a certain earnings before interest, depreciation, taxation, and amortization. All right, so that's EBITDA. Now, then you have the most important aspect of any business, which is when a management has to come to office to basically generate cash for shareholders. It is not to generate profits. Remember that. Again, people tend to value companies based on profits. That can be okay up to a point, but can be highly misleading beyond that point. And we always like to focus on seeing a company's cash generation rather than seeing the amount of profit, because the two can diverge very, very substantially, extremely substantially. And there are lots and lots of examples of this happening. I can share a few examples with you later in this program. Then the most important question that we need to ask company management is their capital expenditure program. I mean, that is really the central thing that a management is deciding. Because if you think about it, in most businesses, most industries, there is very little a management can actually decide on their own. if you're, let's say, making cement, okay, there's no way you can decide on the price. The price is set by the market, unless you form a cartel. So we're not discussing illegal business practices. We're talking legitimate business practices. You can't decide on selling price. You can't decide on the price of the raw material, right? Because raw material costs are also market determined. You can't decide on the price of your people and the infrastructure cost, because that's again market determined. You cannot determine you cannot have discretion over the interest cost, because if the interest costs in the economy are 10%, then that's what you're going to be paying, give or take 0.5%, depending on the quality of the company that you are. So pretty much everything in a company is determined by the market. Even your sales volume, how much you can sell, is ultimately a function of how much you're allowed to sell by your competition. So the way I look at companies is that you really cannot do anything beyond simply decide on the amount of capital expenditure that you will do. Hence, the only question I ask of management is, please tell me the capital expenditure program that you have for this year or for the next 2 years or as many years that you have clarity over. Don't give me your estimates of your sales forecast. Don't give me estimates of your margins. Don't give me estimates of your of the industry growth. I don't want that, because at the end of the day, those are only opinions, and I don't pay any attention to opinions. Okay, whether it is an opinion of RBI, whether the opinion of the Federal Reserve, whether the opinion of Hindustan Lever, whether the opinion of Cisco Systems, I do not care about opinions, because I don't get paid to listen to opinions. I get paid by the market to make my own opinion. So I will make the opinions myself based on what I decide and after my analysis of what the industry size will be, what the company share will be, what the company margin will be. But what I cannot decide is how much money the company will spend on capital expenditure. So I ask only one question, and after that my meetings are over. So I rarely meet management. I only ask my analysts to go and get this number for me. They can meet the management and get whatever the view they want, but I make the decisions from there on. So I keep my whole security research model very, very simplified. Okay. So as I was saying, that meeting company management is largely a waste of time, and I stopped meeting company managements back in the late 90s. So it's like nearly 15, 17 years now since I really sit down and discuss with any company management what the business looks like, how the future looks like, how the next 6 months look like, because I realized they have no clue, and usually they will lie about their business outlook, or they will be overly optimistic. I've never met a management which is realistic about its growth prospects, is realistic about the industry prospects, realistic about the macro prospects. And in fact, in reality, I have found that nearly all managements are very poor judges of macro cycles. Macro cycles meaning where for a country like India, how much GDP growth you will have, or for the world, whether we're looking at a 3% growth in global GDP, whether we are looking at 6% growth in global GDP, whether the US economy is going to strengthen or falter, whether India will accelerate or not accelerate, whether inflation will come down or go up. I mean, they have no idea. And I'm talking the best of the best, including managements of financial institutions who are supposed to be knowing a little bit about inflation and interest rates. They have no idea where rates are going to go. They have no idea where inflation is going to go. They have no idea where GDP growth is going to go. So really speaking, over my 25 years in this business, I find that managements are the last places we should go to get a forecast on their own industry. Okay, so they are very poor judges of macro cycles, and they're very poor forecasters of their own businesses, and of course the global situation and India situation, their own industries, etc. Okay, and history, corporate history, is replete with massive forecasting errors made by all kinds of companies across industries, be it banks, technology companies. I mean, Cisco Systems in 2000, January, February, had forecast that 2000 was going to be a watershed year for technology companies, and they built up inventories way beyond what in hindsight turned out to be the right level of inventory. And then they had to take massive write-downs on those inventories in the subsequent quarters. I mean, this is Cisco Systems. You would imagine they can walk on water, but no, nobody can walk on water in this business because usually my managements will always tend to be more optimistic than they ought to be. Okay, so whether it is banks, technology companies, infrastructure companies, commodity companies, Mittal Steel, Lakshmi Mittal's company has had a terrible run in forecasting steel prices in the last 4 or 5 years. Absolutely terrible. They have always erred on the side of being over optimistic, and hence now they have a junk status. So that tells you what is the quality of these management. They might be storied businessmen making magazine covers, but I don't regard them as great forecasters. Okay, so and that is something. Keep that dose of skepticism about business leaders, and you will never go wrong in the business of investing. That is really very, very important to take away from this webinar. Okay. Now, the other key to understanding fundamentals is simply lots and lots of reading. I mean, this I cannot overemphasize enough. Most people, students think that they can watch CNBC and become great stock market analysts, or they can read the Economic Times and become great stock market analysts. And I may point out that I don't do either. So I don't watch television and I don't read newspapers. So, I keep my mind very, very uncluttered from the amount of nonsense that goes across on TV channels, be it the business channels or even general news channels. And I also don't waste my time reading newspapers. Ultimately, newspapers, you will find economic news, and my analysts send me just the list of key economic data that have been reported that day, and that's quite enough. I have no interest again in reading opinions of various economists or business people expressed in those pages, because more I read about other people's opinion, the less independent thought I have about my own opinion. And in fact, it tends to cloud my own judgments. It tends to override my own instincts. So I prefer to be more sort of aloof in making and forming my views than engage with the market and with the world in order to form my views, which might sound very sort of extreme of perspective, but that's really, the thing that I have learned most is that you must cut out the noise in this whole game. Because there's so much noise, and really very few, or if at all anybody, has any clue what's going to happen tomorrow. All right, and you should spend that time that you free up in readings. And the more you know about business histories of various industries, the more you know about business histories of various companies across decades, the better you will be at understanding the context and outcomes under which any extent market condition exists. So it's very important to know long-term history. While history is not necessarily a great forecaster for what happens next year, oftentimes you can get a sense of that, hey, this movie has played before, this story has been seen before, and there are times when you can have a reasonable edge over people who have not known that history. So that's very important to understand. You must have a big, voracious appetite for reading, and obviously a great memory to go along with it. Now, in order to do this, you need to spend long hours reading. Estimates and studies show that in order to excel in any particular discipline, you need to devote 10,000 extra hours of focus work to it. 10,000 hours, that's the number. Not many people are capable of doing this, and which is why this business of investing is littered with mediocrity. And this is across country. Don't think the Americans sitting there know a lot more about investing than we do. I mean, I've engaged with them, for the last 25 years, and I find them even more stupid than we are. Trust me, in this business of investing. So 10,000 hours, which means, let's say you're going to do this is 10,000 extra hours. So if the average guy engaging in this business or student is going to spend 9 hours a day on this, you have to spend 3 extra hours, right? So if you do that all year, no breaks, and you're talking about 1,000 hours in a single year extra that you put into refining this craft, learning about this business, learning the history, learning the nuts, learning the nitty-gritty, learning the bolts, everything. That means 10 years of hardcore reading, thinking, analyzing, backtesting, total immersion in this craft will make you hopefully a reasonably okay investor. Anything less than that, forget about it, and this is not the profession for you. Right? Now, let's come to valuation, and that's usually taught in business schools, and that's talked about a lot in the media. I mean, does it matter? That's a tricky question. It sometimes matters, sometimes doesn't matter. I frankly don't pay excessive attention to valuation, okay? Because only at extremes do they really work. A P ratio of 100 times will obviously look extreme. A P ratio of 5 times will look extreme. We need to understand then whether the 5 or the 100 are merited or deserved. But P multiples or 12 times, 15 times, 20 times, you can't tell whether one is good, one is bad, one is expensive, one is cheap. And price to book is ultimately a derivative of the return equity, which is, if you arithmetically you can reduce it down into a formula. It is the price to equity. I'm sorry, price to earnings divided by into earnings by book value. Earnings by book value is nothing but the ROE, okay, which is the profit that you earn by the book value. Book value is really expressed in terms of number of shares. So if you divide the shareholders' worth by the number of shares, you get book value. So earnings by book value is nothing but ROE. The higher the ROE, hence the higher the price to book value. And of course, if you replace the PE in this by the price to book, you get the price to book value derivative. So the higher the return on equity, just looking at the arithmetical formula, the higher the price to book or higher the price to earnings. Now, that is a common mistake. Again, you'll find very noted investors, analysts talk about that the price to book for this stock is 10 times very expensive. And I say you cannot tell whether it's expensive or not unless you tell me what the ROE is. All right. So you can't just look at PE and price to book in isolation and say that X is very expensive and Y is very cheap. You have to look at the ROE first and foremost in order to determine whether that price to book is high or low. All right. DCF again, very widely used, very commonly taught. It has. You should know what the arithmetical formula is. You should know the meaning of it. You should know how it is derived. You should know how to calculate it. But there are obviously a lot of assumptions that go into it. We have the entire cost of capital, the returns, the growth. All those things can be very, very volatile, and no company knows how to forecast, or nobody in the whole wide world will tell you what a company will look like 20 years from now, 10 years from now, even 5 years from now. So it becomes really a very theoretical exercise where the values you get are all over the place. So don't get too fixated on a DCF value for a business, because almost no business has that kind of visibility, right? Very useful to know that at the back of your mind. The way we look at free cash flows is that we tend to value near-term cash flow, okay, which is the next 3 years, and value that as a percentage of the market cap of a company. So we discount the next 3 years cash flow, and then we look at it as a percentage of the market cap of the company. So let's say market cap of the company is 1,000 crores, and the value of its next 3 years free cash flow, discounted present value, is 500 crores. So we say that the near-term cash flows are 50% of the overall market value of the company. That is a high number. So the higher this number, the higher this ratio, the cheaper the stock. So that is one way to eliminate the uncertainties associated with long-term DCF forecasting. Okay. And the same thing can be done for the P ratio by adjusting for the growth rather than just say that 10 is cheaper than 12 times or 12 times is cheaper than 15 times, etc. Okay. Now, in summary, valuation is a very complex exercise. It's a really, really complex exercise. There are very many flaws with all the conventional means. So you will really need to go very deep into this whole art and science of valuation. At the heart of it, really, it's an art. And once you have seen companies, business cycles, a lot of things, you will know at your gut whether this stock is cheap or the stock is expensive. Because all the conventional methods have lots and lots of flaws associated with them. Right. Now, let's come to the real crux of this inner game of investing. The only method I have seen work consistently, and there are a lot of methods. You can buy value stocks, you can buy growth stocks, you can buy technology stocks, you can buy cement stocks, you can buy whatever auto companies, you can buy infrastructure companies. Each of them has themes which are temporary. They can last for a few years and then they go away, right? There are no permanent themes in market. Themes keep changing. Okay, like banking was a hot industry in March and suddenly it's a pariah industry. By the time July came around, so things can change very quickly. Nothing really is permanent in terms of investing themes. So sometimes low P stocks will do well. Sometimes high P stocks will do well. But the only theme that I have seen work consistently across market cycles is momentum. And that is the enduring theme about markets. And that means price momentum and outperformance momentum. And 99.99% of fund managers in India and abroad, they completely ignore momentum as a tool to win this game of investing. And I am not complaining, because if they started doing it, then that metric would also become overused. And anything that becomes overused loses its value in market. And that's again very important to understand and remember. So almost everybody ignores it. Okay. And which means that the market's whole preoccupation is with looking at companies, balance sheets, numbers, etc. And they ignore price momentum and outperformance momentum. And that opens up a huge window of profit for people who understand how momentum works and who understand how to play the game of momentum. A deep study of price and relative outperformance and underperformance momentum is central to winning the investment game. And I cannot emphasize this enough. Okay, that learn the art of momentum, long-term momentum. I'm not talking daily or intraday momentum. I'm talking long-term momentum analysis. And in order to understand momentum, you have to go really deep into the vast body of literature that exists, and then divine from that what works best for you after extensive backtesting. And there is no shortcut to this. Trust me, I've done this over decades. That you have to test out every single hypothesis of momentum. You can make your own momentum indicators also, based on the amount of knowledge you gain out of studying the conventional momentum indicators. But ultimately, you have to go really deep into the mathematics of momentum and then the art of momentum. And there are a huge number of books available to enable you to get there. You can keep reading. I mean, I have to keep reading even now. It never really stops. So I mean, it might seem like a lot of work, but unfortunately, we really have to do that in order to make a rupee or two in this game of investing. And like I was saying, that it might sound like a lot of work, and unfortunately, that is true. I don't want to sugarcoat this for anybody listening in. It is a very, very, very tough game. It is arguably the toughest thing out there. You can run a small business, you can run a large business. You will never have the kind of ups and downs that you will have as an investor. And I mean, just to give you an example, a very large client of ours, managing billions of dollars, he was having a terrific run for 2.5 years. And in April, I was having a chat with him, and he was very, very happy with his performance. And I told him that now comes the dangerous part, because your happiness tells me that the trades you have put on have run their course. Okay, and those are the moments when the market will turn around and hurt you really badly. And since May, okay, that was when the Federal Reserve announced this tapering policy, which turned out to be a no taper policy. That's another matter. And then obviously markets have been all over the place, and then up and down. And the fund's performance is hurting, and that's hurting because you were too happy. You became too happy. The moment you become too happy in this game, you should start getting worried, because that means that your trade is about to get over. Okay, so that is, and all those perspectives you will learn when you put in the 10,000 extra hours. Because when you put in those 10,000 extra hours, you will develop a completely unique perspective and a unique system of investing and trading, which will be owned by you. It will belong to you because you have tested it, you have understood it, you have played with real money using it, you have then modified it based on whether it worked or it didn't work, what was the shortcoming, what was the lacuna in that. You've ironed it out, you've gone back to the drawing board. It's an iterative process. Nothing is perfect on day one, and I still have to keep perfecting our own method. But once you have done that, once you put in the 10,000 hours, you develop your own very uniquely yours method of investing, then it will become very rewarding and it will become very, very time efficient as well. I mean, that's the other point, that it doesn't mean that after that you have to keep putting in extra 10,000 hours to win at this game. You still need to put in a few hours. But once you have a method developed, it becomes a very time efficient, almost a speed method of getting the outputs you want in terms of what you should be doing in market. And like I don't spend more than an hour or 2 hours every week on markets, nothing more than that, because I don't need to now. The simple reason that the methods and the tools that we have put in place, largely automated, they tell us enough of where we need to be focused on and what we need to completely ignore. And you can stay out of markets. I can go on a holiday. By the way, one of the big pitfalls of investing is that people cannot take time off. If they're playing golf, they're still going to be checking their Blackberries and see whether markets are up or down, and they're sitting with friends. They still have to take a break and check their phones or their gold or oil is up or down. I mean, then there is no life, okay, because you're then a prisoner to this entire game of investing and trading. And I find that very abhorrent. So one of the promises I had made myself when I started is that I would never become a prisoner to the screen. And by God's grace, I have kind of gotten close to that because I don't have to check the phones, I don't have to check the screens every half an hour or 1 hour. Broadly, if I know where markets are and where they're trading and what our systems are telling us what we should be doing, then by the way, we still lose money. Okay, it's not to say that we make money on every single trade. That's not possible. Even God, if he were to be doing this, would never make money in every single trade. It's just the strike rate that that matters. And as long as the markets are doing what they are supposed to be doing, and that's very important to understand. As long as they're doing what they're supposed to be doing, then there's no need to be excessively involved in them. Then you can go out to a shopping mall with your family and enjoy life instead of always being chained to a desk and a chair and a screen. As I have mentioned, it's a lot of work, 10,000 hours, 10 years, then testing it, refining it, modifying it. All of that is unlikely to happen before you turn 45. Okay? So let's be clear, that's the other sobering part. I don't know what your age groups are, you must be somewhere in your 20s. I'm pretty sure. It's a long haul ahead for you to be able to be a serious player in this business. Okay, so don't think you're going to be a boy genius at 30. You might have 1 or 2 good years when you start trading because the market is very smart. It will lure in people who are rookies with some easy profits, just like a casino. And before you know, it will take all and more of it back. So those are the other rules of the marketplace. So you will have some beginner's luck. But the real game will start when you have reached the age of 45. And beyond that is when you are really, you've seen cycles, you've seen 20, 25 years of trading history, trading patterns, industries, businesses, companies come and go. A vast amount of data exists in your brain. Every single price point in the marketplace exists in your brain. And then your brain has become a really potent computer filled with huge amounts of data. It has processed it. All that will take 20 years' time, okay, for you to get there. So your best years will begin after this age, and after that, hopefully you should become a billionaire if you keep doing things right. Never become complacent, never become too happy, never become too sad. You really need to remain almost like a saint in this. Don't get too carried away by the good times, never get too depressed by the bad times. Then both will keep coming with alarming regularity. So winning this game is also about the mind, not just about your computer. The temperament to win is very, very important. So if you look at Sachin Tendulkar, it's not just because he knows how to play the cover drive or he knows how to play the straight drive. It is also the ability to take the pressure. It's the ability not to get carried away when he is batting on 100, that he needs to go on to a double 100. It's the ability not to get too cowed down by the crowd, by the pressure, by the quality of the opposition, by a string of bad runs, because you're a cricketer, you play 200 tests, you will go through bad patches of 10, 20 tests. It will happen to everybody. So the ability to handle that is what determines a great cricket player. The ability to handle that will determine what a great investor or trader will look like. So that's pretty much it from my side. I'm open to questions, and thank you so much for all the patience.
Ladies and gentlemen.
All right. So I've got a question here, which is, you all can hear me, right? Okay. So this is a question from Alpesh. That I'm a student of semester 4, and the question is that, are you emphasizing 10,000 extra hours to run your business? However, we are employees in pharma giant Pfizer. So as an employee, how many hours we will all spend to update ourselves? Well, trust me, there's no option. Whether you're an employee of Pfizer, you're an employee of Citibank, you're an employee of Sun Computers, or you're an employee of Infosys. If you want to excel at this game of investing, 10,000 hours need to be put in minimum. Okay, that's 3 extra hours a day, 1,000 hours a year, times 10 years. Okay, so that's something that is non-negotiable. Let me put it this way. So you need to find the time. If you need to sleep only 3 hours a night, by all means do it. But you cannot put constraints on this and say, hey, I am working for X company. How can I do this? If you can't do this, forget about it. Then you cannot excel at this. It's as simple as that. Look, this business promises you untold riches if you get it right. Now, you can't get riches without sacrifices. This is your sacrifice. Your 10,000 hours will be your sacrifice. When you're not going pubbing, you're not going to a movie, you're not going out, hanging out with friends. You can do that once in a while. It's not all the time. But by and large, you have just put this in front of you and said that nothing else matters. Okay. So that's the short answer to your question. Okay. I have a question from Shrikant. Is there any good reference book can you suggest to understand the concept better? Oh, there are lots and lots of reference books. Valuation by Tom Copeland is a very good book. Valuation by Damodaran is a good book. On momentum, there are lots and lots of momentum books. You can go to Amazon and do a search for trading analysis, momentum analysis of stock, etc. You will find like dozens and dozens of books. You have to read all of them. Again, now remember, please, that's where the 10,000 hours comes in. You have to plow through literally. I mean, I have a library in my Bombay home of close to 2,000 books. Okay, only on finance. That's a lot of books to read through. Trust me. But I have had to find time to read through all of them, and I still need to read. I don't read finance books too much now because obviously a lot of them don't add value anymore. But through my teens, 20s, 30s, early 40s, I've had to read all of them. There's no option. So there's no one book or two books. There are lots and lots of books. You need to invest a lot of money, by the way, in becoming rich and successful in this business. So please invest in books. I mean, if you need to get any single advice in terms of what your personal capex has to be, it has to be only on books. Questions?
Hello. 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 Hello, Professor Sharma.
Thanks very much. Any other questions?
Hello, Professor Sharma. I have been working in a very big organization, and my senior are having more than 10,000 hours of experience. And every morning they are sharing their experience with me, and we are debating and.
I didn't understand your question, Alpesh. You are saying that, as you are saying that ROE is high, it's good, but if GDP is low in that particular segment, what to do? I'm not clear about this question.
Professor Sharma, we are getting a sharing experience of our senior. He is having much more than 10,000 hours experience, and it will be not benefited to us. Hello.
Alpesh, can you rephrase your question? I'm not clear about what you're trying to ask.
Professor Sharma, I have.
Yes, you're talking about a particular industry. Yeah, go ahead.
Yeah, I am talking about the particular industry.
What's your question?
I am having a more than 15 years of experience, and I have been working with very senior executive who is having more than 40-year experience, and we are just sharing his experience and learning new things from him.
So you're saying that if in a particular industry the ROE is good, but the growth of that industry is not good. Is that basically what your question is?
The growth is good, ROE is also good, but we are sharing his experience, and his experience will not be benefiting to us.
Well, in that case, really you need to find growth options. So a lot of companies in that situation will look for an acquisition to boost growth. I don't think it is necessarily a good idea to do that, but that's one of the ways that companies try to grow out of growth slumps. So Pfizer is a good example of a high ROE company with very poor growth prospects.
So my senior executives are having a very good experience.
Looking like a great company. It used to be a great company, a great growth company, but obviously, the inability to find blockbuster drugs, the inability to find blockbuster drugs, and it's hard to keep coming with blockbuster drugs. This is all putting paid to companies like Pfizer, etc. Growth prospects. It's very hard for them to keep finding such. It's like a movie star who has to keep coming up with mega hits, every year, and it's very hard. People go through tough times, and you can have a big lean patch. So that's what a company like Pfizer is going through, and that's really a high ROE company with poor growth prospects. I mean, there are like literally dozens and dozens. So the other option you have is to basically distribute the cash to your investors and let them decide what they want to do with the cash. And that's the only sensible thing that a high return on equity but a low growth company should be doing. Because look, every company has a life cycle. There are no permanent growth stories, as I mentioned. You will hit a wall in terms of growth at some point. A very large company cannot keep growing more than the GDP of the particular market or the global GDP. So at that point, you really must make a decision that you have basically become a low growth cash generating business because you don't have much capex anymore since you're not growing. So just keep distributing out the cash and become a big dividend machine. That's the model that most companies adopt when they reach growth plateaus with high ROEs and high cash flows. Question? Acquisition is one solution, not necessarily a good one. But the other solution, of course, is just to become a dividend machine. That's assuming that you've exhausted all options of growth. Become a normal dividend machine. Keep churning out dividends to your investors. They'll be happy to hold on to your stock. A stock like Pfizer is reasonably in the last 4, 5, 6 years time has had very good dividend yield of 5-6%. When interest rates are 2% in the US and you're giving a 5-6% dividend yield, that's a terrific premium over the conventional bank deposit rates or the Fed fund rates. So you become basically a dividend machine. That's really what a company like Pfizer has become. Question? Yes, you can invest in new technologies. That's what I said. Look, every good management will try to exhaust all available growth options, be it through acquisition, be it through development of a new technology, all those things. But assuming that you haven't been able to still grow, then what option do you have? You simply return the cash to your shareholders. That's pretty much it. And that's what companies like Pfizer will continue doing. Okay, so I've got a question. It says that does investing to 10,000 hours is applicable only to finance books, or are you referring depending on the type of work? No, 10,000 hours means doing extra 10,000 hours in whatever your chosen field is. If you want to become an architect, 10,000 extra hours of understanding architecture. Whatever is involved in learning that particular art, craft, skill. Okay? You want to become a musician, want to become a singer, want to become a carpenter, whatever. Okay. I'm not. This is irrespective of the profession. If you want to become a great investor, 10,000 hours. Great carpenter, 10,000 hours. Great musician, 10,000 hours. Anything you want to do, 10,000 extra hours need to be put for you to become a very accomplished practitioner of that particular art. I hope that answers your question. Okay, Alpesh is asking, but you need extra capital, then your ROE comes down. Well, no. Your ROE will come down if the new opportunities you're exploring, okay, are not profitable enough. But let's say you're making a 45% ROE. It is worthwhile sacrificing a bit of ROE, maybe 2%, 0.3%. That's where your capital budgeting decisions will come in. That am I prepared to give up for the short run a little bit of ROE in order to boost this ROE up with the use of an acquisition or any kind of innovation that I'm planning to do. So ROE is again a moving number. It's not a sacrosanct number under all circumstances. And companies make decisions that look, for the next year, 2 years, I will reduce my ROE by a couple of percent points in order to take a bit of business risk. Now, those are judgmental things. I mean, they're very hard for us to make a decision sitting here in without knowing what the business, what the company is, whether they're doing the right thing or the wrong thing. Okay. So, yes, you can sacrifice some ROE in order for you to go for a little bit of extra growth in the years to come. It may work, it may not work, nobody knows for sure. Okay, so for any good investor, what is the main thing, fundamentals or technicals? Well, you can't differentiate the two, do both. Most people do only fundamentals, and I always say, please put equal, if not more emphasis on technicals. And that's where momentum analysis falls. So momentum falls in the school of technical analysis. And please pay a lot of attention to technicals, which is really not looking at the intraday moves and all those things. That's not really going to help you a lot. Although I watch that also whenever required at crucial turning points in the marketplace. So I have a big history of price movements at various turning points in the marketplace. But understanding momentum it falls in the camp of technical analysis, and by all means pay a lot of attention to it. But almost no fund manager pays any attention to it. Okay, so now, as a businessman, what do you look for? ROE or ROI or ROE? ROI is nothing but return on capital employed, and obviously that is more important than return on equity, because that is the total amount of capital you are employing in your business. So obviously, ROI, which is ROCE, is the more important metric to use. Okay, have I missed any question? I've answered, Nagaraj. Yeah, Nagaraj, I've answered your question. Please do both. You cannot say I will do fundamentals and not technicals, and vice versa. But technicals play, in my view, a more important role than fundamentals do. But don't try doing it without the other one. So they are both integral. Both are completely integral. Technicals seem very easy. We watch the people coming on channels and they keep talking utter nonsense. That's not technicals. You need to go a lot deeper into the art and science of technicals. But that's true of fundamentals as well. So, both are important. Technicals I find a little bit more important because of momentum. Okay, Alpesh, may you elaborate on free cash generation? I mean, what do you mean? I mean, I'm sure you're reading that in your courses. Free cash is basically the cash flow that you're left after having spent on things like uh, capital expenditure, working capital, uh, and any other day-to-day use of capital that you might have, whatever cash you are left in order to service your debt and or your equity, depending on whether you're calculating cash flow to the firm or to the equity shareholders. So that's really what free cash is, that what you're left to give to your constituents, your stakeholder, be it the debt stakeholder or the equity stakeholder. That's what a free cash generation. Okay, so Nagaraj to everyone. Will market momentum study give hint of sudden market fall or rally because of market news or policies? Well, yes, it does. It does. It does. I mean, ultimately, remember, no policy, I mean, almost no policy is hidden from market participants. So, understanding market momentum also gives you a window into the participation of people who know the news in advance. Okay. For instance, just now in the case of this tapering thing, okay, I'm sure you guys have followed it. Did you follow the tapering issue from the Fed? Okay. Now, the Fed had led us to believe that they would be starting some degree of tapering, right? And then it announced no taper. But guess what? Emerging markets started to rally 15 days or so before this announcement of no taper. And obviously, no taper's biggest beneficiary are emerging markets, okay, like India, like Brazil, China, Russia, Indonesia, Thailand, Philippines, okay. The market started to rally 15 days before the actual announcement from the Fed came that they will not be doing any tapering. Now, obviously, that didn't happen out of some random move. It happened because market participants got to know. Some people got to know that this is what the Fed's decision was going to be. It happens with alarming regularity. Insider trading happens in every single market in the world. The way to learn insider trading legally is through the art and science of watching price movement. Okay, so I don't have to be privy to any insider information, but enough movement of the marketplace prior to a certain news, many times will tell you what the market is going to be doing. Okay, because some insiders know, and that is how the certain price actions are happening in the marketplace. And it happens, trust me, in every market in the world. So that's the answer to the question, that it will, on a number of occasions, tell you in advance what policies are going to be. So it's very important to watch your price action. Very important. Next question. From free cash generation means it's capital leverage or something else. No, not capital leverage. Free cash generation is basically net operating profit less invested taxes, okay, plus depreciation minus working capital changes, minus or plus depending on whether you have reduced working capital, increased working capital, minus capital expenditure, minus activity. Okay, that number at the end of it that you are left with is free cash flow. Free cash flow then you can apply basically through reduction of debt or for dividends or both, okay, depending on how much free cash you have generated. So, again, to understand the arithmetic of that, I'm sure you can ask your professor, or you can, like I said, Valuation by Tom Copeland is a great book. Valuation by Aswath Damodaran is a great book to understand the principles of free cash flow generation and the principles of discounted cash flow analysis. So please go and buy these books, or I'm sure they might be in the library, and read up on them. You get the exact thing, what I'm talking about. But it's not capital leverage. That's complete. Leverage is leverage. So don't confuse the two things. Okay. So risk analysis can be done through these tools of market momentum. I don't know what you mean by risk analysis. Risk analysis means a lot of things. So what exactly do you mean by risk analysis? What do you mean by risk analysis, Srikanth? Next question. Any other questions? Why? Okay, Nagaraj. Why delivery of stocks and payment credit is taking 2 3 days on the system? Well, that much time it will take. Excuse me. That much time it will take. That's the settlement mechanism. That much time it takes anywhere in the world. So, you know, I mean, those things. Maybe it might be reduced by a day or so, depending on how much banking automation we get. But you know that's pretty much what you will find as standard across the world. On page 2, everyone. Risk analysis market related, but momentum is run by employee. What's your comment? I can't understand this question. I'm unable to understand what this means. Please explain the question better because I cannot understand what you're trying to ask. Risk analysis taken by management. Are you talking business risk analysis? What risk analysis? Trading risk, business risk, capital budgeting risk. What are you talking about? Yes, obviously. Then, when you're making a capital budgeting decision, risk analysis is central to that. What are the downside? What are the upside? And hopefully, all of that you're capturing through the discount rate you're using to discount the cash flows from that capital budgeting decision. So that's how you will account for business risk. That's obviously done by the management, by the board, by the subcommittees of the board that have been set up to analyze a particular capital expenditure decision. Next question. Any more questions? Sure.
It's my pleasant duty and task to sum up this morning session. 2 or 3 things stand out significantly before my mind. One is the intense attention your lecture provided, sir. Thank you so much for the great learning. Secondly, the interest also that your observations generated is amply substantiated by the huge number of questions that were asked of you. Personally, and I hope and I'm sure that I'm speaking on behalf of everyone, the few things that you left behind in our minds is that it is very important to avoid the pitfalls you mentioned when you are thinking in terms of investing and trading. It is very important to have your own individual views and be independent and not listen to market information that may not be always reliable. What really gladdened my heart was your suggestion that we should read more. 3 hours a day, 1,000 hours a month. I think that's wonderful advice. I try to follow it. And I agree with you that this is a very difficult job, but I have benefited the way you have said. We'll all benefit. I wish to thank you on my behalf, on behalf of all the students gathered here, and on behalf of the AVAGMAH Online School, for a wonderful session.
Right, gentlemen. Thanks very much.
Bye-bye.